Hi, and welcome back to another one of our videos here about the college process. Once again, my name is Ed Zamora from Principia Prep. Today we're going to be discussing the different options to help pay for the college tuition bill. But before we start, if you'd like, please give us a comment below letting us know what additional content and college processes, whether it be financial aid or admission, you'd like us to cover. And if you'd like to be notified of when new videos are coming out, please click our subscription button below. And if you enjoy the content that we have on the video, please give us a like. It actually does help our channel a lot. Now today we're going to discuss the 3 different ways you can elect to pay for the college tuition bill. The payment plans, using your college savings, i.e. your 529s, or taking out a college loan. We're talking about the pros and cons for all 3 of the different processes and ways to get. But before we delve into the 3 different ways to help pay for college, first we have to discuss the college bill. Now typically the college bill will arrive sometime between June and July. On the bill, you want to make sure to go through the entire thing and make sure, number 1, first thing I always tell parents to look for is the health insurance. Now, by law, each college must provide their students coming on campus with health insurance. Now, if you already have health insurance for your student, very simple. Contact your health insurer and ask them, my students going off to college next year, are they covered? If they are covered, call the school's financial aid office, or essentially their billing office. Let them know that you already have health insurance for your student and will not need the school's health insurance. That way you can reduce the bill right off the bat. Typically the health insurance provided by the college veers in between $1,500 to around $4,000 of cost. So obviously this is a big cost savings if you already have health insurance for your student. Second thing to look for on the bill is, are the financial aid things we're supposed to be getting, the grants, the scholarships, the federal direct loans we're using for the students, are those things already being deducted from the bill we're looking at, so we know whatever monies we need to come up with is the final product, the final number. Subtracted out the financial aid components that already should be in there. If they're not already in there, contact the billing office, ask them when you can expect a bill, or when they'll have an updated bill showing you all the financial assistance you're getting, and if it's not going to be on there anytime soon, what will be the amount after you subtract financial aid from the bill. Now, that being said, with the bill typically comes a brochure or a flyer or some kind of notification from the college indicating their payment plan process. So let's start talking about now the first of the 3 ways to start paying for the college bill: the payment upfront or the payment plan. Now, right off the bat, you can pay the college specifically for the term bill, because when the college sends you a bill in June or July, the billing amount is actually for the fall semester. You'll be getting another bill in December or January for the spring semester. So whatever you're paying is just for half the academic year. Now, talking about the fall bill specifically, you can pay that off with cash, check, or a credit card, which kind of brings up one of the strategies I do see a lot of families utilizing when paying off the term bill. If you do have money set aside for the student's academic term, let's say the fall bill amount, and the college has a credit card option, but they don't have a convenience fee, because a lot of these colleges, unfortunately, do have a convenience fee of anywhere from 1% to 3%. So if there's no convenience fee and you're able to pay off with the credit card, the benefit here is you get the reward points, or I guess the cash back, whatever your credit card may offer. This only makes sense, however, if the convenience fee is lower than the reward you're going to get, or there is no convenience fee, or as well as those 2 factors, the fact that you have the money ready to pay for the college. Then I think utilizing this as a strategy makes a lot of sense. I have seen parents use this as an option. That being said, let's talk about the different payment plans most colleges offer. Now, once you receive the bill in June or July, a payment plan brochure or some kind of flyer or some kind of indication of the college's payment plan offers will be in there as well. Typically, most colleges will offer an 8-month payment plan or a 10-month payment plan, so you can go in kind of any direction. This is what most colleges offer. When it comes to the 8-month payment plan, it's 4 payments in the fall and 4 payments in the spring. When it comes to the 10-month payment plan, you're essentially paying starting in the summer before the student starts college, and the payment typically ends, the last payment will be due in April, because they want you to end the payments before the academic term ends, or I guess the academic year ends, and you're paid up. Now, that being said, if you want to do the payment plan, typically it requires anywhere from a $50 to $90 fee to set up with the college, as well as you have to provide them with checking account routing information because they debit the account every month. That's typically the way a payment plan works. Now, when it comes to the payment plan, I like using these before I have to start using a loan. One of the reasons I like these is if you have a small amount due. So let's use an example. You have $40,000 due to the college for the year. The college has been generous with you and provided you with $35,000 of financial aid assistance, scholarships, grants, loans for the student, etc. So we have a $5,000 balance. In this case scenario, rather than taking out a loan of $5,000, I would like to see if possible to utilize the payment plan, the 10-month payment plan, and pay $500 a month instead of taking out loans and adding more debt. Now, of course, each family situation is different, so you want to make sure that this is something that's affordable to you. But if it is, this is one way I would consider paying for the college costs, by basically spreading out the payments rather than taking out a loan. You can also consider, in the same scenario, let's just say the college cost $50,000 a year. And let's assume they've given you decent financial aid, but not the whole thing. So you have, let's say, $30,000 in financial aid assistance, leaving you with $20,000 balance. Now, let's say you have in college savings $10,000 or $15,000, once again, we'll use that number, of college savings available. Before I took out a loan, I would use the whole college savings to reduce the amount down to $5,000. Then, once again, I would do a payment plan to set up. That way, I can make sure that hopefully, if this works for your family, to reduce the opportunities to add to the debt pile for your student. The goal is always to minimize the amount of debt your student has when they graduate college. That being said, let's start talking about the second part here, the college savings plans and how to utilize them to help pay for college. Now, if you're considering using your college savings plans, let's first discuss the type of plans we're talking about here today. There's technically two types of 529 plans that you save for college. There's the prepaid, and then there's the college savings plans. We're not talking about prepaid here. Going forward, we're only going to be talking about the college savings plans. Now, when it comes to the college savings plans, in my eyes, I like to utilize these first before we take out any additional debt. Now, when it comes to the federal direct loans that are in the student's name, I typically 9 out of 10 times, if not even more, on a percentage basis, tell students and parents, take out the federal debt because it makes the most sense in almost every case scenario families are dealing with. The loan is in the student's name. It's got a very low interest rate. In some cases, doesn't even have an interest rate if you're talking about the subsidized portion. Now, if you're unsure about the federal direct loans for your student, below we have in the description our other video about the student loans, the 3 different types. If you want to watch that video, we go very in depth about the federal loans, the state loans, and the private loans. And we have a lot of very good information in that video about the student's federal direct loans specifically. Now, when it comes to either choosing the 529 plan to pay for college or the loan, I typically usually lean towards paying with the college savings available, 529 funds or whatever else is available, before I take out a loan. Now, based on the financial environment we all find ourselves in, interest rates are very, very low, which puts us at a weird situation where in some cases it makes more sense to utilize a loan over the 529. Or I guess in my case scenario, where I think it makes a lot of sense to kind of make a consideration. I call it the 4% rule. If you can get a private loan for 4% or less, in those cases, I would consider using the loan in place of the 529. So why 4%? Let me explain. When it comes to most 529 plans, most college savings plans, they're mostly age-based. So whether you're going with a conservative plan or an aggressive plan, as you can see here, what will typically happen is the closer your student gets to college or enter into the college age or are in college to begin with, what happens is the plans become very conservative, which means they go away from the equity side and go more into the conservative investments, the money markets, the T-bills, the CDs, etc. Things that have very little return but are extremely safe. But the problem is in the financial environment we find ourselves in, where the Federal Reserve has lowered rates down to 0, at this point in time, it's very difficult to get any return back from these investments. So if your idea is to fund the college plan now, as far as the bill, with a loan, and then hold off on the 529 plan, it might make sense. But let's make sure that we're using the right figures and numbers when dealing with this process. And what do I mean by that? Well, if you have a 529 plan, and let's say it's very conservative, and the best case scenario you're looking at is a 2% return on that investment, and you decide to go out and take out, let's say, the Parent Plus loan, which has an interest rate of 7%. What'll happen then is you're technically taking out a 7% interest rate loan when you're only returning back 2% on your college savings because it's so conservative. So essentially you're costing yourself that 5% in the middle there. This doesn't make sense. Now let's use another example. Let's say you're able to go out into the market for the student loans and get yourself a 2% rate, which is not impossible nowadays. I'm actually seeing rates as low as 1.5%, in some cases even 1.25% on some of these loans. So let's say you go out and get a 2% interest rate loan on the private side, and your fund is returning back 2%. This may be a great case scenario for a few factors. Number one, the two even out. So you can hold on to your money and lock in an extremely low rate, which might not be there a year, 2 or 3 years from now. So it's a good idea to lock in the rate now. Now, when it comes to the college savings of the 529s and the college savings specifically, let's talk about 3 different environments I see families falling into, 3 different categories. Category number 1, you've overfunded the account, or it's grown way further than you need to, or the student doesn't need as much of the 529 funds because they got a lot of scholarship money or grant money, or something came into play where you have more money than needed. One of the first things I would consider doing is, right off the bat, taking out no loans. Reason being is because taking out loans when you have so much money available doesn't make sense, because if your student graduates and you don't have anyone to pass on the 529 funds to, you're going to get penalized on the gains up to 10%. Okay? Now, another thing to consider is, if you do have way more money than you need, is utilizing those funds to pass on to someone else. Based on the 2017 changes to the plans, the 529s, the college savings plans, as well as the 2020 plans, what I would consider doing is taking out the federal direct subsidized loan in place of just using the 529 funds. Now, you might be thinking, well, Ed, you just told us before, don't take out a loan if you have the funds available. But there's a trick here. There's a strategy involved. Based on the 2020 tax changes to the 529 plan, you're now able to pay back $10,000, a lifetime amount, $10,000 in student loans. So what I would like to do is, even if I had more than enough money to pay for the college, I still would suggest taking out the 529 money, not all of it, but using some of it to pay back the federal direct loans. And the reason I would take the subsidized federal direct loan specifically is because that loan is being paid for, the interest, by the federal government, so it's not accumulating on itself, which is the best way to go. So what I would do is, over the course of the 4 years, I would take out $2,500 of the federal direct subsidized loan, because you can choose the amount up to $3,500 each year. I would take out the $2,500 amount, because that over 4 years is $10,000. Then when the student graduates, they have a 6-month grace period to pay back that loan. What I would do is take that excess 529 fund monies, pay off the $10,000. By doing so, you, number one, build a student's credit score, as well as establish their credit score, which is a great way to start their life with a credit score showing they've paid off loans in the past. Now, the second scenario that I see a lot of families fall into is you don't have enough 529 funds to pay for the whole 4 years, but you do have enough to cover, let's say, a year or 2. In these case scenarios, we go right back to the 4% rule again. If I'm able to lock in a rate low enough at this point in time, then I'm locking in the rate. Then I'm looking to use the 529 funds. But if I can't, I am not looking to spread out the 529 funds available at this point in time. What I'm looking to do is pay off the total first year or total first and second year if I have enough funding, then look to take out loans later on for years 3 and 4. Now, you might be wondering, well, Ed, if the environment's so low right now, even if I can get a 6 or 7%, why wouldn't I? Main reason being is that because what you're going to notice is whether you're taking out a federal loan, a state loan, or a private loan, they all grow every month on itself as far as the interest. So interest is accumulated every month. So if I can avoid a year or 2 of interest building, I would rather do that than taking out a loan early on, unless I can get a low enough rate for or below. Then I'm okay with doing that. But if the rate is higher, I'd rather get the loan in year 3 or 4 and then start paying it back, rather than taking out year 1 and 2 and having essentially 3 or 4 years of interest accumulating on that loan, because right there, you're probably missing out or eroding any possibility of having an okay interest rate in the mix. And let's talk about category number 3 I see families falling into. where you've tried to save up for the college savings to try to get as much as you can in there, but life events or things have taken hold and you haven't been able to save enough. Maybe you don't even have enough for the first year. What I would do is, in this case, is take the entire 529 fund you have and pay whatever amount you can towards the college. So let's just say the college tuition cost is $20,000, but all you have is $10,000. I would just send in the whole $10,000. Then look to see if I can do a payment plan for the remaining balance, if it makes sense for your family financially, if it's something you can afford to do. Or I would look to take out a loan at that point in time. But once again, I'm trying to minimize loans, and I'm especially trying to minimize loans in the beginning because of the amount of interest that's accruing over the term between the first year and graduation or the second year and graduation. I'm trying to eliminate the time frame of just adding more interest on top. Now, that being said, let's talk about the third criteria to paying for the college bill, taking out a loan. Right off the bat, when we're talking about loans, the goal is always to get the lowest interest rate available. That being said, in the description below, we have a list of the ranking of the top 5 loans we like at this point in time, based on terms and interest rates available. In the description, you'll see that each one of the different loans has the link to go directly to the site to make it very easy for you to essentially shop around. Now, before we begin, I often get the question of, should we take out a loan for the academic term, for the year, or for the whole 4 years? Now, when it comes to taking out a loan, you're only able to take out the loan for the academic year. So you can't take out a loan for all 4 years, which is something you wouldn't want to do anyways, because once again, if you took out a loan for the whole 4 years, you're essentially adding interest way earlier than you wanted to for the senior year or junior year or even sophomore year. Years before that school year starts, you're adding interest, which is something you wouldn't want to do. This is why you wouldn't want to take out a loan for all 4 years from the get-go. Now, when it comes to taking out a loan, whether you should do a semester or you should do the year, I typically suggest just taking out the loan for the entire year just to make the process easier on yourself. So when you're taking out the loan, you essentially say to the lender, I'm taking out for the whole year. So what you want to do is, whatever the fall bill amount is that you owe, or what you're taking out the loan for in the fall, assume it's going to be the same amount for the spring. So then double the loan. And then they usually tell parents, add $2,000 or $3,000 on top of that, just in case, to make sure you're covered for any incidental expenses, things that pop up out of the blue that you weren't aware of in the meantime. When it comes to loans, you have to remember that whatever you're taking out the first year, this amount will typically grow each year. Colleges increase in price anywhere from 3 to 5% on average, which means if we take out, let's say, the first year a $20,000 loan, the second year we'll have to take out a $21,000 loan. And then the third year we'll have to take out a $22,050 loan, which means by the time we get to year 4, we'll have to take out $23,153. Which means that if you were just assuming you're taking out $20,000 each year, you thought you were taking out over the course of the 4 years $80,000, when in reality you're taking out at least $86,202. This is not factoring in, by the way, the fact that I mentioned before that loans are growing on themselves on a monthly basis. They're adding the interest in every month. So you're really looking at more along the lines of $90,000 in student loan debt. Now, I don't want to discourage families from taking out loans. Loans are a great way to bridge the gap between the funds you have available and what the school is giving you to help pay for the college costs. But you want to make sure that these factors come into play when you're thinking about paying for the college. That being said, let's talk about strategies to paying for college and the way I look at it when considering taking out student loan debt and what level of student loan debt makes sense for families. Now, when taking out debt for student loans, the first question I always ask families is, what is the major or what is the career path the student has in mind? The reason I'm doing this is because if the student indicates a career path or a major in mind that I know has a good demand or a high income level associated with it, then I'm okay with discussing or talking about student loan debt or taking on larger amounts of student loan debt. In 20 years of doing this, I've seen student loan debt increase every year to nowadays where the levels are traditionally, on average, I'm seeing students with over $100,000 in student loan debt on average across the board. And I work with and see somewhere between 2,000 to 3,000 families a year. So that's a lot of student loan debt. But if I know the major they're going into or the job opportunities are available and they pay a good salary, in a lot of cases, I'm not so deterred by the debt. But once again, it all comes down to your family, what you feel comfortable with as far as taking on debt or not taking on debt. Another question I'm asking, when we're looking to take on student loan debt, specifically if I'm considering a private loan versus a plus loan, a parent plus loan, the federal loan, is the age of the parent. Now, if you're talking about a parent who is at the age of 65 or older, I typically like to lean towards taking out a parent plus loan over the private loan, unless the private loan rate is very good, the 4% rate once again, or below. The reason I'm considering taking out the parent loan in the plus loan rather than taking out the private loan scenario is because in the parent loan for the federal loan option, if something happens to the parent and they, God forbid, pass away, or if other factors involved are they are unable to work based on disability or other considerations, that we have a link below, by the way, for when you can discharge a federal plus loan. So if you want more information, below in the description, we have a link for that. What happens is, if this happens, the federal loan, the parent plus loan, is then basically eliminated. There is no longer a loan in place. This is one of the reasons I'm considering parents' age when I'm looking at taking out a parent loan through the federal government, a state loan, or a private loan. The third thing I think about when I'm taking out a loan, and this is more of a discussion really with the student, either myself with the student or you as families can talk about this with your student, is what makes sense to you? And what I mean by that is this: every student loan that you're taking out at the end of the student loan or within the framework of you working on the student loan, it's going to indicate how much this loan will be, what the terms are, how long the student is paying back the loan, and how much the debt will be that they have to pay back each and every single month. What you want to make sure is, whatever that number is says you have to pay back each month, that your student realizes this amount is going to be multiplied by at least 4 for most families. Which means if the student loan is saying you're paying back $250 for the first year of loans you're taking out, then you factor that over 4 years. So let's just say $1,000. I'm not, of course, adding in the extra interest that accumulates over the years. I'm just saying, just basic, we're looking at $1,000 in payments each month. Is this something that makes sense to you as a student? Does it make sense to me as a parent, basically guiding my student? Now, if you know your student's major is going to be in something that doesn't pay more than $30,000 or $40,000 a year for years and years and years, and your student is looking to take out debt that requires them paying back, let's say, $1,500 or $2,000 a month in repayments, then in this case scenario, either the college probably doesn't make sense as far as return on investment, or the amount of loan debt doesn't make any sense as far as return on investment. Because if your student's only making $30,000 or $40,000 a year and they're paying back $2,000 a month in student loan debt, that virtually means that after you take out the student loan debt portion, they have virtually no money to live on. Believe it or not, most students I talk about this with see the numbers when you put them in front of them and let them realize from a numbers perspective, maybe this does or does not make sense. But it's best that you discuss these numbers with students because, once again, the more debt your student has, the more issues they have with paying off that debt, the more difficulty down the road they'll have. I have seen some students, good, bad, or indifferent, essentially mortgage their 20s and 30s to go to a college because it was either way too expensive or out of the price tag, or loans were available, so parents and families just jumped on the loan bandwagon, good, bad, or indifferent, and took out the loans for the student. Now, I'm not saying loans are a bad way to bridge the gap, but it has to make sense financially for your family. Now, that being said, here are my general rules when paying for the college. Right off the bat, if you have the funds available, I typically will say send the funds in, whether it's a checking account, savings account, 529 savings account plan, a UTMA, UGMA, which we didn't cover today, but we do have other videos about those as well. If you do have the money available, I typically say send the money in. If you do elect to use a loan in place of the money you have available, make sure you're getting a very good rate and locking it in. 4% or below is typically the number I like to see. And the third thing, and probably the last thing I'll tell you about here today, as far as paying for the college, is if the money seems to be too much that you're shelling out, or if the loan amounts seem to be too much, you have to do one of two things. You either have to figure out a way to minimize the amount of debt your student's getting into, whether that be living off campus, or whether that be moving in and staying at home and commuting to the college, or finding ways to mitigate the cost by taking summer courses at the community college at a lower rate. Or the other way of looking at it is you have to find a different college, good, bad, or indifferent, because student loan debt, unfortunately, based on all the changes to the tax code and the federal government making changes over the years, Student loan debt, as far as going into bankruptcy and erasing that debt, is almost impossible. Now, with all that being said, if you do have questions or concerns, or if you have any comments, please leave below any additional videos you'd like us to talk about. As you see here on the screen is our contact information. If you'd want to reach out to us, we do have our phone number as well as our email here. We do assist parents with the entire college process. We also have a newsletter that goes out monthly for students in high school, letting them know what they need to be doing every single month. If you want the newsletter, just shoot us an email, letting us know what high school you're from, as well as the year your student is in. And once again, if you wouldn't mind leaving a comment and a like, and if you want to be notified of our upcoming videos, please click the subscription button. Once again, my name is Ed Zamora from Principia Prep. Thank you very much.